Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com, obviously coming to you live. And here's what we're going to cover today. We're going to go over the new low parade because it is growing, and there are some big important stocks on this new low list. And this is telling you that we've basically had what I think is a game changer in October. We're going to look at the percent above exponential moving average indicators. They're way oversold. And if you're looking to pick some sort of a bottom bounce, then these are the indicators that might help you do that. We'll look at some of the groups that are holding up relatively well: healthcare, staples, utilities. And you can see on those first two bullets, I've got the but, oversold but, potential reversal zone but. And that's because I think we're in a bearish market environment. And that just leads me to be hesitant with all potential bullish setups. Then we'll turn to bonds, gold, natural gas, and some Q&A. So let's look at some of these new lows just to show you how broad this decline has been in October. This is XLC, and I've just got it going back to June because that's when it started trading. But, you know, it's at a new low for the life of the ETF. Basically, it's trading life. Gap down, lower high, breakdown. You know, it's getting a bounce today. It's oversold, but, you know, clearly there's a lot of selling pressure going into the likes of Google and Facebook and such. And even, you know, some of the video gamers have gotten hit that were holding up, like Electronic Arts. And we've seen, of course, what's happened to Netflix. So this is kind of like the high beta end of the market that has really gotten hit. Here are financials. So financials hit a 52-week low. And when you hit a 52-week low, I think that is that's a medium to long-term problem. All right. Sure, short-term, we're way oversold and we could get a bounce. And, you know, because we had this decline from 29 to 25, we could get a bounce back up to 27 even. All right. But it's kind of like timing a bounce within a bigger downtrend is really not the ideal trading strategy as far as, you know, a new long position is concerned. If you're looking for an exit, okay, maybe you wait for a bounce. But as far as, you know, playing against the bigger trend, that's not my idea. I would rather be in cash or wait for that bounce and then maybe look to get selectively short. But, you know, at this point, we're very oversold and we're in a downtrend. So it's kind of like a no man's land. You're too oversold to be too bearish, but the bulk of the evidence is clearly shifted in October to be bullish at all. So finance hitting a 52-week low, that's not a good thing for the market. Industrials hitting a 52-week low. And look at this. This is like a 52-week high. And then I think it's 29 days or so later, you have a 52-week low. I'll put on the inspect so we can look at that. I've clicked on the chart. And here we are at a 52-week high. And so I'm going to hold down that click, and then I'm going to drag it to the right, and I'll stop there. And then if you look to the left of the chart, at the left-hand corner under the symbol, you see 27 periods. So basically in 27 periods, this ETF went from a 52-week high to a 52-week low. So the decline was not normal in the middle of October, and it really turned abnormal with the new low. So there's a clear message here that something is not right out there. I'm not going to speculate about what it is because often we don't really know what it is until a few months later. That's the old theory that the charts will lead the fundamentals. So here's materials also hitting a 52-week low. So some key sectors have hit 52-week lows. Sure, they're oversold after a move from 61 to 50. Could even bounce back to 55. All right, then we look within the equal weight sectors, and we can see new lows in the equal weight industrials ETF. This is the one that took 29 days to go from a new high to a new low as well. And then you can see XLI. Sorry, that's small cap in the middle. And then XLI down there. And then we look at materials. We can see the equal weight materials moving to not a new low, but very close to it. And then financials, all kinds of weakness in financials. This is the equal weight financials ETF hitting a new low. And the thing is, we just have a bunch of new lows. It's not like we have them isolated anymore. We had, pockets of weakness throughout the advance from April until September. But these pockets have turned into more than just pockets. Now I think we have more than 50% of the market showing weakness. All right. Home construction has been weak for a long time. All right. Sure, it's firmed up here, but if you're playing for a bounce, it's a bounce within a bigger downtrend. So I'll just leave that one alone personally. Home builders, 52-week low as well. And I know this may seem monotonous, but when you see this many new lows, it tells you that the market is unstable. All right, something is not right, and it is just not the time to be looking for long positions if you even have a 3-month horizon, I think, even a 3 to 6 month horizon, because I think we've shifted from bullish to bearish. Semiconductors, a very important part, of course, of the technology sector, and they were lagging in the summer and then broke down in October to new lows. And then we look at the broader semiconductor SPDR. It hit a new high there in August. It was holding up and leading actually, and then moved to a new low within a 2-month period, less than 2 months. Insurance, another one, a 52-week high in mid-September and a 52-week low at the end of October. That is an incredible about face as far as the market is concerned and what they're pricing in now. Regional banks were lagging the second half of the year with the lower highs, and then the breakdown in September ahead of the market, and then a move to 52-week lows. So it may seem like there's a bargain out there, but stocks are not the kind of thing you want to buy when they're on sale. All right, you want to go to the retail store to buy something that's on sale. We want to buy stocks when they're trending higher and they have momentum in their favor. And right now they don't. Here's the biotech SPDR, started making some lower highs and then plunged to a 52-week low. Oil and gas was lagging pretty much all year, the oil and gas equipment and services SPDR, and then plunged to a 52-week low. Copper miners were lagging all year and new lows throughout the summer and the fall here. Metals and mining lagging all year and then plunging. That's a 52-week low on a closing basis. All right, there. So this just shows you how broad the weakness is out there. Steel did not hit a 52-week low, but it hit a new low for 2018. So when there's this much weakness in the market, it's sending a message. So here are some key stocks that are hitting 52-week lows. And I think you can argue about uptrend, downtrend, but when a stock is at a 52-week low, it's pretty much in a long-term or a strong downtrend. So here's Citigroup, a big bank, plunging to a 52-week low. Could it bounce back to that broken support zone around 69? Sure. But is it in an uptrend? No. Is it leading on the way down? Yes. Caterpillar, all right? Let's just forget the excuses. It is what it is, all right? A plunge to a 52-week low from a key industrial stock. Facebook started lagging there in the summer when it had this gap and never recovered and kept moving lower and hit 52-week lows in October. So it's gone from leader to laggard from summer to fall. FedEx, all right, this is kind of like a litmus test for global shipping. The big air freight forwarder, all right, look at that, a breakdown and a 52-week low. So this is not a good sign for the global economy. And in previous presentations, I've showed breakdowns in the DAX and new lows in the Italian and the Spanish and Portuguese stock markets, as well as Shanghai. All right, Goldman Sachs hitting a 52-week low. If Goldman can't perform, who can in the banking sector? Lockheed Martin, even the big defense contractors are breaking down. You know, this stock was starting to show some leadership there at the end of September and just gave it all back up. Minnesota Mining and Manufacturing, 3M, breaking down to 52-week lows. Nvidia, all right, the darling of the semiconductor group, as short a time ago as late September, 52-week high there, and then 4 weeks later, a 52-week low. All right, something that's really shaken up the semiconductor group. Even though oil is trading up over the past year, Schlumberger cannot move higher, and it moved to a 52-week low. And Texas Instruments, this is one of the broadest semiconductor stocks that you can find. They make all kinds of semiconductors, and they couldn't get to new highs and broke down to a 52-week low. So when you look at these charts, something is not right in the stock market, and it tells us we probably need to be looking elsewhere. So I think a lot of people are afraid of missing the bottom. I think there are more people afraid of missing the bottom than further weakness. And that is a concern, because I don't think catching the bottom is the main point here. We don't want, I'd rather be late to the bottom. But if you're looking to catch a bottom, there are some indicators you can use, like the percentage of stocks above the 20-day moving average. And so you can get it for the S&P 500, the S&P Mid-Cap 400, small caps, and the NASDAQ 100. And over on the left, you can see the symbol. It's exclamation point GT20 SPX. And then you just substitute SPX for MID to get mid caps, SML for small caps, and NDX for NASDAQ 100. So I like to put them all four on one chart. Oh, by the way, on that symbol, you can substitute XLK, XLB, XLI, if you want to see these sectors and the percentage of stocks above the 20-day EMA. But I like to put these all on one chart to try and compare performance within these various indices to see which ones are holding up or not. And so I'm just going to go to an S&P 500 chart because it's a little bit less cluttery and we can just focus on one. So I've got some lines here at 70 here, atop, and 30% below, and 50% in the middle, just so you can kind of see it. And you can see here, you know, from October 2016 until January 2018, we're getting above 70% with relative ease and on a regular basis, several dozen times. All right. And every time we got to around 30%, we would get a bounce. But that changed in January, February 2018 when we plunged below 30%. And you can see that these plunges that we've had this year have been a bit deeper. We've gone below 10% at least 4 times. All right. And we didn't get above 90% on these runs here, barely above 80%. So there's kind of been a shift here. And this has been a really hard hit that we've had here in October, but we became very oversold. And you can see here in February when we got below 10%, we were quite oversold and we got that bounce. And then again in March, we got below 10% and we even got a little bit of a divergence and we got a bounce and then started a choppy advance. So now we're very oversold. We've got a little bit of a divergence working because we've held above the prior low. You can see here where the S&P 500 has a lower low. I'll go ahead and give you a little bit of a drawing there. So there we have a lower low, and you can see we've got a higher low there. So it looks like we're setting up for an oversold bounce. I don't know how long it'll last because I think that bigger downtrend could pull Trump at any time, because the bigger downtrend is the dominant force at work here. So also want to show you, if you want to see how I created this chart, you can see I had to add the indicator twice. And the second time I put it behind the indicator window. And I have one as dots and one as solid. And that's how I got these dots here on the chart. But let's go back and look and see what happened in 2015. So I'm going to move this slider here. And that was a very volatile period in the market. And you can see I've got a lot of drawings on there because I've looked at this before. So before we were, getting these, let me go ahead and clean that up a little bit. There's a nice little trash can here where you can delete all annotations. And I'll click OK. And then I will close that to save it. And now we get a nice clean chart. So we can see here, we went below minus 10% there in August 2015 and got the bounce. And then on the test of the lows, we held above 10%. So that was a little bit of a divergence there. That told you fewer stocks were participating. All right. And then if we fast forward to 2016, we had a low in there as well. So you can see we plunged down below 10% there in January, and we had a little bounce, and then we had a test of the lows, and we held above that. So if you get a nice divergence in this indicator, it tells you fewer stocks are going below their 20-day EMA, and that might set up for a potential bounce here, as it did even in 2015 and 2016. And if you look here, see, we didn't get below 10% in September. In October, we had a little divergence there, October, November of 2016, and that, of course, set up this really big run. So you can get these indicators for the S&P 500, S&P Midcap 400, and the NASDAQ 100. All right, if you're interested in trying to time a bounce, but I personally am not interested in that. If you look at the percentage of stocks above the 50-day EMA, we can do that for these same indexes. All right, you can compare prior levels, but you can see this this 10% level is the lowest that we've had since February. So the market has really been broadsided. And look at the small caps and the NASDAQ 100. That's the lowest level of the year as far as the percentage of stocks above the 50-day EMA. The NASDAQ 100 has gone from the leader to the laggard. Small caps were leading in the summer, and they've gone to the laggard category as well. And you can also do this indicator for the 200-day moving average. And you can see here that we didn't get below 30% for the S&P 500, but we did for mid caps, small caps, and the NASDAQ 100. So less than 30% of stocks in the S&P Midcap 400, S&P Small Cap 600, and NASDAQ 100 are above their 200-day EMA. The vast majority are in downtrends. All right, that's why the market environment has shifted from bullish to bearish. And the actual shift occurred in mid-October. All right, so what is holding up? And I'm really wary to even show you things that are potentially bullish because of the broader market environment. But, healthcare is holding up. If I had to pick a potential reversal area, well, you can see it's in that 50 to 62% zone. And we stalled for a few days, and maybe we're going to turn up and bounce. But healthcare is not immune. I mean, healthcare moved from 96 to 87 in October. So if the broad market takes another leg lower, healthcare is probably not going to survive. Of course it's going to survive, but it's going to take another hit. All right, if you look at staples, they're holding up. All right, I thought this was a breakdown, but it's recovered. But staples are still holding up. I'm still not that excited about staples. And utilities are still holding up. But again, anything that's a stock, I'm just not that excited about. And that's pretty much 80% of the stock market, because 20% might buck the trend, but finding that 20% is going to be a really difficult task. All right, now let's turn to junk bonds. All right, this is the high yield bond ETF. And, it's been trending down for most of the year. started trending down in the latter part of 2017. This is the PPO 5200. So it's negative when the 5-day EMA is below the 200-day EMA. And it got really negative, but it didn't affect the S&P 500 that much. But one thing I've noticed is I went to the Fred database, and I follow this chart, and it's basically the high yield, the US high yield. So what is the yield of the junk bond market? What do junk bonds yield? And the higher that yield is, the more investors are demanding in return to own junk bonds. And that's negative. That kind of tells you there's a bit of a credit crunch going on out there. And we can see that this is at its highest level of the year. All right, it's taken a sharp move higher in October. And so that is not good for the credit markets here in the US. And that supports kind of the bear market thesis that junk bonds are underperforming. So you can go to the Fed database and find this. It's under interest rates, corporate bonds, and then you see US high yield master. All right, and then we look at TLT versus HYG. Well, TLT got a little bit of a bounce in October, but HYG, which acts more like stocks, moved to a new low. So no bounce there, no love for high yield. And then when I look at TLT and IEF, I'm still long-term bearish of both of these. I mean, they had 52-week lows in the early part of October. And this bounce, I think, is going to be a counter trend bounce. It's going to end at some point, maybe around 101.5 for IEF. You can see TLT is a little bit, it's less strong, okay? It's just kind of consolidating with a wedge or a pennant. And if it breaks down, it's going to signal a continuation lower. So I'm still bearish on bonds. Gold is one of the shining parts of the market right now. Now, it's down the last 2 days, but you can see that gold did get the breakout here, and this breakout zone around 115, 114 is holding. And I would say if you go below 114 on a closing basis, then you reevaluate. All right, but this reverses a downtrend that started basically with the May breakdown and lasted until August at 111, and then consolidation. And it looked like we were breaking down to the downside, but got the head fake and the break to the upside. So gold is looking positive. And one thing that's interesting is the correlation between gold and the dollar is very high on the positive side. Highest it's been in a long time, because you can see the dollar is moving up. Now, gold's been moving down for the last 2 days, as I said, but the dollar is moving up. So the dollar seems to be a safe haven as well of some sort. Maybe it's money moving out of the euro, because there's the euro moving down. And of course, the euro accounts for 57% of the dollar. So if the euro moves down, the dollar does move up. And then we can see the yen is also in a downtrend. So I would expect the euro to move lower. Maybe we'll move to parity even. Now, oil is at a moment of truth. Now, oil is part of the risk on group, all right? And it took a hit in October along with the rest of the market. And so because it's part of the risk on group, I would probably not be interested in oil either. And then you look at oil stocks, and they're clearly not excited about what's happening in oil. But there's the hit in oil. This is the continuous futures. But if you're really interested in oil, I'd recommend you check out the December light crude contract. And that is the little caret sign there at the top left, CL. Z is for December, and 18 is, of course, for the year. And you can find these symbols. If you go to the upper right of any web page, you've got the little search icon. And I'm just going to search for the caret. And when I get my results, I'm going to get nothing. But that's because I'm looking for symbols. So at the bottom, I'll click symbols. So it's going to show me all symbols that contain this caret. And there you can see I've got all of the commodity contracts that we cover. So you can follow all of the commodity contracts. And this is like going straight to the source. All right. The USO, the oil ETF, is based on these commodity contracts. All right. So if you want to know what USO is going to do, you probably best be looking at these December contract, which is, of course, the most active one. There you can see the volume moving up there. That means it's the most active. But it's at a potential support zone and firming, but it's down again today, as we'll see with USO next. So there's USO. It's moving down. And USO can be used short term. I mean, that's not a problem. So a breakout at 1450 is needed to reverse this slide in crude. And then nat gas is performing well. All right, this is the continuous contract, which is good for long-term charts. All right, you can see the breakout there. And then you can see this is December natural gas. And it had a huge breakout. And it's got this throwback and this broken resistance zone turning into support. And it firmed yesterday. And if we look at the UNG, which is an even worse tracker than USO, you can see that it has pulled back and maybe it's a little bit of a wedge. So maybe watch for a bounce here. But again, the main point is the financial markets have been hit broadsided and things are not quite right out there. And it's going to take some time for this volatility to subside. And that's why I think, being in cash is not a bad idea. Now, as far as cash, some people ask, so how do you know when to go into cash? Well, basically what I'm doing is when I turn bearish, I have stops on the trend following system. So when a trend is broken and your stop is hit, you exit and you just don't enter a new position. And so that is why you will build cash as you exit those positions and you don't enter a new position. Now, if you keep entering positions, of course, you're not going to build up cash. But as the market declines and those stops get hit, you keep exiting. And that is why you will build up cash. And so somebody was asking me about moving averages and which ones were the best. And, normally I use the 50-day and the 200-day for the S&P 500. All right, but you can see the 50-day is still above the 200-day for the S&P 500 here. It has yet to cross. But I've already turned bearish. And why is that? Well, there's another System Trader article that shows the breadth indicators that triggered bearish. And when that happens, I'll use a shorter moving average or maybe the 200-day or maybe just turn bearish based on the breadth indicators. But the point is, you need to have that plan in place before it happens. And when the bad events do happen, you're ready to act because you've made a plan. And that's where I get this plan your trade and trade your plan. And cash really is a position. So, I could be wrong. We got whipsawed in 2015. There were some whipsaws in 2011. But the point is to have that plan and execute that plan. And so I will leave you with that today. Thanks very much for tuning in and have a great day.